welcome to episode 4 of the MLO Exam Prep Podcast. So far, we've covered mortgage loan origination, calculations, and disclosures. But now we're shifting our focus to ethics in mortgage lending. In this episode, we'll explore the role of ethics in mortgage lending, how ethical and unethical practices impact the industry, the legal framework surrounding ethical conduct. Ethics isn't just about passing the test, it's about building a successful career as a trustworthy mortgage professional. Let's dive in. Why ethics matter in mortgage lending. Ethics plays a critical role in consumer protection, market stability, and regulatory compliance. And MLO's primary responsibility is to guide borrowers toward the best possible loan for their situation, ensuring that they understand the terms without deception or pressure. Real-world impact of unethical lending. 2008 financial crisis. Predatory lending and unethical loan approvals led to massive foreclosures. Many borrowers didn't fully understand the risks of adjustable-rate mortgages (ARM) and negative amortization loans. The crisis led to new regulations, such as the Dodd-Frank Act, and increased oversight from the CFPB. As an MLO, your ethical decisions protect both borrowers and the financial industry. Key ethical concepts and regulations. Ethical mortgage lending is governed by laws designed to prevent discrimination, fraud, and deceptive practices. Some key laws include Equal Credit Opportunity Act, EOA, prohibits discrimination based on race, color, religion, national origin, sex, marital status, age, or public assistance income. Fair Housing at FHA ensures equal access to housing without discrimination. Truth in Lending Act, TILA, requires clear disclosure of loan terms and costs. Real Estate Settlement Procedures Act prohibits kickbacks and referral fees between mortgage lenders and other parties. Dodd-Frank Wall Street Reform and Consumer Protection Act created the Consumer Financial Protection Bureau, CFPB, to regulate mortgage lending practices. Exam tip: expect questions that test your understanding of which laws protect consumers from discrimination, fraud, and unethical lending. Examples of unethical lending practices. Some common unethical practices include predatory lending, targeting vulnerable borrowers with loans they can't afford or that have excessive fees. Steering, pushing borrowers toward more expensive loans that benefit the lender rather than the borrower. Misrepresenting loan terms, hiding balloon payments, prepayment penalties, or adjustable rate features. Inflating income or assets, encouraging borrowers to exaggerate income to qualify for a larger loan. Understanding these unethical practices will help you identify them on the test and in real life. Closing thoughts on Part 1. Ethical lending is not just about following laws and regulations, it's about doing what's right for the borrower. Understanding ethics will help you pass the exam, build trust with clients, and succeed in your career. Up next, we'll explore UDAPE, unfair, deceptive, and abusive acts and practices, and how they apply to mortgage lending. Part 2. Welcome back to episode 4 of the MLO Exam Prep Podcast. Now that we've established the importance of ethical lending, let's dive into a key regulation that protects consumers from deceptive practices, UDAPE. Unfair, deceptive, and abusive acts and practices. In this section, we'll cover what UDAPE is and how it applies to mortgage lending, examples of unfair, deceptive, and abusive practices, the legal consequences of violating UDAPE. Let's get started. What is UDAPE? UDAPE refers to unfair, deceptive, and abusive acts and practices, which are prohibited under the Dodd-Frank Act and enforced by the Consumer Financial Protection Bureau, CFPB. Definition of UDAPE violations. Unfair practices. Causes or is likely to cause substantial harm to consumers that they cannot reasonably avoid and is not outweighed by benefits. Deceptive practices. Misleads or is likely to mislead consumers, and the misleading information is material, i.e., affects decision-making. Abusive practices. Interferes with a consumer's ability to understand loan terms or takes advantage of their lack of knowledge. Exam tip: if a question asks whether a practice is deceptive or abusive, look for whether it misleads, hides information, or exploits borrower vulnerability. Examples of UDAP violations in mortgage lending: unfair practices, charging undisclosed or excessive fees that harm the borrower, bait and switch tactics, such as advertising a low rate and then changing the terms, deceptive practices, misrepresenting loan terms, interest rates, or fees, telling a borrower their rate is locked in when it isn't, abusive practices, pressuring a borrower into an unaffordable loan, failing to adequately explain complex loan terms. Consequences of UDIP violations. UDAP violations carry serious penalties, including fines and lawsuits. The CFPB can issue millions of dollars in fines for violations. License revocation. MLOs who engage in unethical lending can lose their ability to originate loans. Reputational damage. Companies that violate UDAP lose public trust and risk bankruptcy. Exam tip. Expect a UDAP-related question on the exam, typically testing your ability to identify deceptive or abusive lending practices. Closing thoughts on Part 2. UDAP violations are one of the biggest compliance risks in mortgage lending. Understanding what constitutes unfair, deceptive, or abusive behavior will help you avoid violations and ensure that you're always acting in the best interests of borrowers. Up next, we'll take this discussion further with real-world ethical dilemmas and how to handle them. Welcome back to Episode 4 of the MLO Exam Prep Podcast. So far, we've covered ethical lending practices and UDAP violations, and now we're turning our attention to specific protections for high-cost and high-risk loans. In this section, we'll cover the Home Ownership and Equity Protection Act, HOPA, the right of rescission under TILA, protections for high-cost and higher-priced mortgage loans. Understanding these rules is crucial for passing the exam and for ensuring borrowers are protected from predatory lending. Let's get started. HOPA, the Home Ownership and Equity Protection Act. The Home Ownership and Equity Protection Act, HOPA, was passed in 1994 to protect consumers from predatory lending practices in high-cost mortgages. It is an amendment to the Truth in Lending Act, TILA, and establishes strict guidelines for loans that exceed certain pricing thresholds. HOPA applies to high-cost mortgages, including refinances, home equity loans, and closed-end second mortgages. Does not apply to purchase loans, reverse mortgages, or HELOCs. Exam tip. If a question asks about HOPA protections, remember that it only applies to high-cost mortgages, not regular purchase loans. Defining a high-cost mortgage under HOPA. A loan is considered high-cost under HOPA if any of these conditions are met. APR threshold. The APR exceeds the average prime offer rate, APR, by 6.5% for a first mortgage, 8.5% for a second mortgage. Points and fees threshold. The total points and fees exceed 5% of the loan amount for loans above $24,866, 2024 limit. Prepayment penalty restrictions. The loan includes a prepayment penalty that lasts longer than 36 months or exceeds 2% of the loan amount. Exam tip. Expect a question asking how to identify a high-cost loan under HOPA. If the APR, fees, or prepayment penalties exceed these limits, the loan qualifies as high cost. Restrictions on high-cost loans. If a loan meets HOPA's high-cost mortgage thresholds, the lender must comply with strict requirements. No balloon payments, with limited exceptions, no negative amortization, no prepayment penalties, mandatory homeownership counseling. Lenders must also verify borrower repayment ability, meaning no stated income or no doc loans. Exam tip. If a question asks about HOPA loan restrictions, the correct answer is likely related to limiting risky loan terms, like balloon payments and negative amortization. Higher-priced mortgage loans, HPMLs, versus high-cost mortgages. A higher-priced mortgage loan, HPML, is not the same as a HOPA high-cost mortgage, but does have additional protections. A loan is an HPML if its APR exceeds the APR by 1.5% for first lien conforming loans, 2.5% for jumbo loans, 3.5% for subordinate liens, second mortgages. HPML protections. Mandatory escrow accounts for at least 5 years. full income and asset verification, strict appraisal requirements. Exam tip: a question may ask you to differentiate HPMLs from HOPA loans. Remember, HPMLs are higher priced but not necessarily high cost under HOPA. HPMLs require escrow accounts and stricter underwriting rules. Right of rescission, TILA Section 23. One of the most important borrower protections under TILA is the right of rescission, which allows certain borrowers to cancel their loan within 3 business days. Right of rescission applies to refinances, home equity loans, and HELOCs on a borrower's primary residence. Does not apply to purchase transactions, second homes, or investment properties. How it works: borrowers have 3 business days, excluding Sundays and holidays, to cancel the loan. If they rescind, the lender must refund all fees within 20 days. Exam tip: if the lender fails to provide proper rescission disclosures, the borrower's rescission period extends to 3 years. Exam-style quiz questions. 1. A loan is considered high cost under HEPA if A. The borrower's income is below 80% of the area median income. B. The APR exceeds the APOR by 1.5%. C. The points and fees exceed 5% of the loan amount. D. The borrower has a low credit score. Correct answer C. HOPA defines high-cost mortgages based on APR, points and fees, and prepayment penalties. 2. The right of rescission applies to which type of loan? A. Purchase loans. B. Loans for second homes. C. Cash-out refinances, VA loans. Rescission applies to refinances, home equity loans, and HELOCs on a borrower's primary residence. 3. Which of the following is true about a higher price mortgage loan, HPML? A. It has the same protections as a HOPA high-cost loan. B. It applies to all loans with an APR higher than the APR. C. It requires escrow accounts for at least 5 years. D. It allows stated income underwriting. Correct HPMLs require escrow accounts for at least 5 years. 4. What is the maximum rescission period for a borrower if a lender fails to provide required disclosures? A. 3 business days. B. 30 days. C. 3 years. D. No rescission period applies. Correct answer: if the lender fails to provide proper disclosures, the rescission period extends to 3 years. Closing thoughts on Part 3. Understanding HOPA, HPMLs, and the right of rescission is critical for preventing predatory lending practices. In Part 4, we'll discuss prohibited lending practices and mortgage fraud red flags, ethical responsibilities in mortgage advertising, how to handle ethical dilemmas in real-world lending situations. Stay tuned. Welcome back to Episode 4 of the MLO Exam Prep Podcast. So far, we've covered ethical lending practices and UDAPE regulations, HOPA and high-cost mortgage protections, the right of rescission and how it protects borrowers. Now we're shifting our focus to prohibited lending practices, mortgage fraud red flags, and ethical advertising. Understanding these topics will help you avoid violations and ensure compliance with federal regulations. Let's get started. Prohibited practices in mortgage lending. Federal law strictly prohibits practices that mislead, exploit, or financially harm borrowers. These include kickbacks and referral fees, RESPA Section 8. It is illegal to give or receive a fee, kickbacks, or thing of value for referring mortgage-related business. Example: a lender cannot pay a real estate agent for referring borrowers to them. Penalty: up to $10,000 fine per violation and/or 1 year in prison. Loan steering, TILA and Dodd-Frank Act. MLOs cannot push borrowers into more expensive loans to earn higher compensation. MLOs must ensure that borrowers receive loan options that meet their financial needs. Penalty, fines, loss of licensure, and legal action. Equity stripping and asset-based lending. Equity stripping occurs when lenders approve borrowers for loans based solely on home equity without verifying their ability to repay. Example: approving a high-interest refinance for a borrower with no income, forcing them into foreclosure. Penalty, fines, and potential lawsuits from borrowers. Misrepresenting loan terms, TILA and UDAP. Lenders and MLOs must provide accurate, truthful information about loan terms, interest rates, and fees. Example: an MLO Cannot advertise a no-cost loan if fees are rolled into the loan amount. Penalty: fines, legal action, and potential revocation of licensure. Discriminatory lending, ECOA, and Fair Housing Act. Lenders cannot discriminate against borrowers based on race, color, religion, national origin, sex, marital status, or public assistance income. Example: denying a qualified applicant because they receive disability benefits. Penalty: lawsuits, fines, and reputational damage. Mortgage fraud red flags. Mortgage fraud is a serious crime that carries severe penalties, including imprisonment. The most common fraud types include fraud for profit, industry professionals manipulating loans to make illegal profits. Fraud for housing, borrowers misrepresenting income, assets, or employment to qualify for a loan. Common red flags for mortgage fraud: inconsistent borrower information, mismatched addresses, sudden income increases. Large, unexplained deposits in bank statements. Fake employment records or unverifiable employers. Inflated property appraisals. Borrowers who seem unaware of loan details. Exam tip: if a test question asks how to handle suspected fraud, the correct answer is to report it immediately to a supervisor or compliance officer. Ethical advertising in mortgage lending, TILA and RESPA rules. Mortgage advertising is heavily regulated under TILA and RESPA to prevent deceptive or misleading loan promotions. TILA advertising rules. If an ad mentions specific loan terms, it must include all required details. Example: if an ad says low monthly payments, it must also state the APR, annual percentage rate, whether payments include taxes and insurance. If the loan has adjustable rates or balloon payments. Prohibited practices. Bait and switch advertising. Advertising a low rate that's not actually available. False no-cost loan claims. If fees are included in the loan amount, they must be disclosed. Omitting key loan details. Ads must include repayment terms, interest rates, and APR. Penalty: hefty fines from the CFPB and FTC, legal action, and loss of licensure. Exam-style quiz questions. 1. Which of the following is a violation of RESPA? A. A real estate agent referring a borrower to a lender without compensation. B. A title company providing a lender with marketing materials at cost. C. A lender paying a real estate agent for each client they send. D. A mortgage broker disclosing lender credits on the loan estimate. Correct answer: C. RESPA strictly prohibits referral fees or kickbacks between mortgage professionals. 2. Which of the following loan types is most likely to involve predatory lending? A. VA loan. B. FHA loan. C. High-cost HEPA loan. D. Conventional conforming loan. Correct answer: C. HOPA protects borrowers from predatory high-cost loans. 3. Which statement about mortgage advertising is true? A. If an ad states a payment amount, no additional disclosures are needed. B. TILA requires ads with trigger terms to disclose the APR. C. Lenders can advertise no-cost loans without clarification. D. Bait and switch tactics are legal if the borrower signs a disclaimer. Correct answer: B. TILA requires all loan ads mentioning rates, payments, or fees to disclose the APR. 4. What is a common red flag for mortgage fraud? Borrowers with steady employment history. B. Unexplained large deposits in bank statements. C. Property appraisals that match recent sales in the area. D. Borrowers who provide tax returns and W-2s. Correct answer: B. Unexplained deposits can indicate an attempt to inflate assets. Understanding prohibited lending practices, mortgage fraud red flags, and advertising rules is crucial for staying compliant and ethical. In Part 5, we'll wrap up ethics in mortgage lending with ethical scenarios and real-world dilemmas, how to handle pressure from borrowers, lenders, or employers, final quiz questions to reinforce key ethics concepts. Stay tuned. Welcome back to the final part of Episode 4, Ethics in Mortgage Lending. So far, we've covered ethical principles and lending laws, UDAP and prohibited practices, HOPA, high-cost loans and mortgage fraud red flags, TILA and RESPA advertising rules. Now, we'll apply everything we've learned by working through ethical scenarios, real-world dilemmas, and final exam-style questions. Let's get started. Handling ethical dilemmas in mortgage lending. As an MLO, you'll face pressure from borrowers, lenders, and even employers to cut corners or bend the rules. Knowing how to handle ethical dilemmas will help you stay compliant and protect your career. Scenario 1. The inflated income. You're working with a borrower who doesn't quite qualify for the loan they want. They ask if you can adjust their income slightly so they can qualify. They claim they'll be able to make the payments and just need help getting approved. How should you respond? Explain that misrepresenting income is fraud and that all income must be verified. Offer alternatives, like a larger down payment or a cosigner. Document the interaction and report any ongoing attempts to commit fraud. Exam tip. If a question asks what to do in an ethical dilemma, the correct answer is usually to refuse the unethical request, document it, and report it if necessary. Scenario 2. The loan steering pressure. Your manager tells you to steer borrowers into higher-cost loan products because they generate bigger commissions. You know that some of these borrowers qualify for lower-cost loans. What should you do? Prioritize borrower interests and present all qualifying loan options. Explain to your manager that loan steering violates TILA and RESPA. If pressured, escalate the issue to compliance or HR. Exam tip. Steering is an unethical and illegal practice. Loan originators must act in the borrower's best interest. Scenario 3. The undisclosed kickback. A real estate agent refers a lot of business to you and suggests a small thank you gift for each referral. They don't call it a referral fee, but that's exactly what it is. What should you do? Refuse the arrangement and explain that RESPA prohibits referral fees. Continue working with the agent, but without exchanging anything of value. If the agent insists, report the issue to your compliance officer. Exam tip. If a test question involves a thank you gift, referral fee, or financial incentive between professionals, it's likely a RESPA Section 8 violation. Final exam-style quiz questions. A borrower asks you to round up their income to help them qualify for a loan. What should you do? A. Make the change as long as it's reasonable. B. Tell the borrower you'll discuss it with underwriting. C. Refuse and explain that misrepresenting income is loan fraud. D. Proceed if the borrower insists they will be able to make payments. Correct answer, C. Any misrepresentation of income is loan fraud. 2. A mortgage loan originator knowingly encourages a borrower to accept a high-cost loan when they qualify for a better option. What violation has occurred? A. Fair Housing Act violation. B. Loan steering. C. RESPA violation. D. Equity stripping. Correct answer, B. Loan steering occurs when an MLO pushes borrowers into more expensive loans for higher commissions. A real estate agent offers to send referrals your way if you give them a portion of your commission. What law does this violate? A. TILA, ECOA. C. RESPA. D. Correct answer, C. RESPA prohibits referral fees, kickbacks, and thank you gifts between mortgage professionals. 4. What should an MLO do if they suspect their manager is encouraging unethical lending practices? A. Ignore it unless a borrower complains. B. Report the issue to the CFPB immediately. C. Escalate the concern to compliance or HR. D. Participate in the practice to avoid correct answer. C. Internal compliance procedures should be followed first. Closing thoughts on ethics in mortgage lending. Key takeaways. Ethical lending protects borrowers and the industry from fraud and financial harm. UDAP rules prohibit unfair, deceptive, and abusive acts. Kickbacks, loan steering, and equity stripping are illegal. Ethical MLOs always act in the borrower's best interest. That wraps up Episode 4 on ethics in mortgage lending. In Episode 5, we'll dive into mortgage loan origination calculations and disclosures, where we'll break down how to calculate LTV, CLTV, and DTI, periodic interest rate and per diem interest calculations, loan estimate, Lee, and closing disclosure CD timing rules. Thanks for studying with us. You've got this.